Passive Income 2026, 3 high-yield dividends for financial freedom. If your money is sitting in a standard savings account right now, you are losing purchasing power every single month, even at 4.5% Fed rates in 2026, because inflation-adjusted returns still barely break even. And here's the uncomfortable truth. The average investor is still chasing growth stocks from 2021, while the top 1% quietly repositioned into high-yield, real-world cash flow assets. This is not 2021. Speculative tech is no longer the easy button. The era of hope investing is over. 2026 belongs to cash flow. And today, I'm breaking down 3 high-yield dividend strategies that are quietly building financial freedom right now. No hype, no lottery tickets, just assets that pay you. The problem / the opportunity. The Federal Reserve has stabilized rates around 4.5%. Infrastructure spending is accelerating globally. Energy demand is rising. Governments are reshoring supply chains. Capital is flowing into real-world assets, RWA. But here's the gap. The average investor is still overweight mega-cap tech, sitting in low-yield savings, waiting for the next bull market. Meanwhile, institutional capital is rotating into energy infrastructure, commodity-linked equities, short-duration government debt, high-yield dividend vehicles. Why? Because in a higher-rate environment, cash flow matters more than growth projections. And dividends, when structured correctly, create compounding machines. If you want financial freedom in 2026, you don't need the next Tesla. You need yield, stability, and disciplined asset allocation. Let's break it down. Pillar 1, Energy Infrastructure Dividend ETFs. Energy demand is not declining. It's shifting. AI data centers, electric vehicle charging, industrial reshoring. All of it requires massive energy throughput. And pipelines, they get paid regardless of oil prices. We're talking about companies structured as energy infrastructure operators, many bundled inside ETFs like Illyrian MLP ETF or Global X MLP and Energy Infrastructure ETF. These vehicles often yield between 6% to 8% annually. Why this works? Stable cash flow contracts, inflation-adjusted pricing, high distribution payouts. From a portfolio diversification standpoint, energy infrastructure behaves differently than tech equities. It provides income stability during volatility. Now, let's run the numbers. Hypothetical example. You invest $1,000 into an energy infrastructure ETF yielding 7%. That's $70 per year in dividends, reinvested annually at 7% with compounding. In 10 years, you're at roughly $1,967. That's nearly doubling your money from yield alone. No speculation, just distribution and compounding interest. But here's the bridge. While energy infrastructure gives stability, it doesn't give you exposure to the global infrastructure supercycle happening right now. And that's where Pillar 2 comes in. Pillar 2, copper and infrastructure dividend stocks. Copper is the backbone of electrification. Every EV uses more copper than traditional vehicles. Data centers consume massive amounts of wiring. Renewable grids require transmission expansion. And supply? Constrained. Top miners are disciplined. Capex is tight. That creates pricing leverage. Now, instead of chasing speculative junior miners, we focus on dividend-paying global producers like Freeport-McMoRan, BHP Group. These companies offer both commodity upside, dividend income. Why this matters for asset allocation? Commodities hedge inflation. Dividend-paying miners combine growth plus yield. Let's model it. You invest $1,000 into a diversified copper producer yielding 4%. That's $40 per year in dividends. But here's the leverage. If copper prices rise 20% over a cycle and the stock appreciates proportionally, now your principal grows to $1,200. Reinvest dividends during that time. Your compounded return over 5 years could exceed 50 to 60% depending on pricing cycles. That's not guaranteed. But it's asymmetric. Income plus cyclical upside. Now here's the hidden reality. Commodities are volatile. They move fast. They correct hard. So, what anchors a portfolio when markets panic? This is where the top 1% are doing something the average investor ignores completely. They're buying government debt, but not the way you think. Pillar 3, short-term treasury yield strategy, the volatility anchor. Let's talk about something that sounds boring. Treasuries. Because here's the uncomfortable truth. In 2026, boring is profitable. With the Federal Reserve stabilizing rates around 4.5%, short-term U.S. government debt is yielding levels we haven't seen consistently in over a decade. And yet, most retail investors ignore it because it's not exciting. It's not a 10x stock. It won't double overnight, but it will protect you. And in wealth building, protection is power. Why short-term duration matters? When rates rise, long-term bonds get crushed. Duration risk increases. Price sensitivity increases. But short-term treasury instruments? They mature quickly. They reset quickly. They adapt quickly. This dramatically reduces volatility. You can access this through ETFs like iShares 0 to 3 month Treasury Bond ETF, SPDR Bloomberg 1 to 3 month T-bill ETF. These funds hold ultra-short-term U.S. Treasury bills. Translation: extremely low default risk, high liquidity, minimal duration exposure. This is not about chasing yield. This is about strategic capital preservation. The compounding reality. Let's run the scenario. You allocate $1,000 into short-term treasuries yielding 4.5%. Year 1, $45. Now imagine reinvesting that yield annually after 5 years, assuming rates remain near this level. That $1,000 becomes approximately $1,246. No volatility stress. No sleepless nights. But here's where it gets strategic. Let's say markets drop 25%. Tech corrects. Dividend stocks dip. Commodities retrace. You now have dry powder, liquidity, optionality, and you can deploy capital into undervalued assets at a discount. That's not defensive investing. That's tactical positioning. The top 1% understand this. They don't stay 100% allocated to equities. They build cash flow layers that generate steady returns while waiting for asymmetric opportunities. Asset allocation context: think of your portfolio like a structure. Energy infrastructure is the cash flow engine. Copper miners are the cyclical upside play. Treasuries are the stabilizer. This lowers portfolio beta. It smooths drawdowns. It improves risk-adjusted returns. And that matters more than raw returns over long time horizons. Because financial freedom isn't built on maximum volatility. It's built on sustainable compounding. But here's the limitation. Treasuries won't make you wealthy alone. They protect wealth. To accelerate income, we need selective high-yield exposure. And that's where Pillar 4 comes in. Pillar 4, high-quality dividend growth ETFs, income with discipline. This is where most investors make a critical mistake. They chase yield. They see 10%, 12%, 14%, and they assume higher yield equals better income. Wrong. High yield often signals high risk, dividend cuts, over-leveraged balance sheets, unsustainable payout ratios. Instead, the strategy in 2026 is selective dividend growth. Focus on quality. Focus on sustainability. Focus on companies that increase dividends over time. ETFs that apply these screens include Vanguard High Dividend Yield ETF, Schwab U.S. Dividend Equity ETF. These funds prioritize strong return on equity, low debt-to-equity ratios, consistent earnings growth, sustainable payout ratios, yield range 3% to 5%. Now, some investors say, why not just buy the S&P 500? Because dividend-focused strategies tilt toward value and profitability factors. And in a higher rate environment, profitability matters more than speculative growth. The power of dividend growth. Here's where compounding becomes exponential. Let's assume initial investment $1,000. Starting yield, 4%. Dividend growth, 6% annually. Price appreciation, 5% annually. Year 1, $40 in dividends. Year 2, $42.40. Year 3, $44.94. And so on. But because you're reinvesting dividends, you're buying more shares. More shares means more dividends next year. That's compounding interest layered with dividend growth. After 10 years, that $1,000 could realistically grow to between $1,900 and $2,100 depending on reinvestment consistency. That's nearly doubling capital without speculative exposure. And here's the psychological benefit. You're getting paid to wait, even during sideways markets, even during corrections. Cash flow continues. That reduces emotional selling, which improves long-term returns. The bridge to risk. But let's be honest, even quality dividend ETFs are still equities. They are still exposed to market corrections, earnings slowdowns, policy shifts, which means one question remains. How do we protect this entire strategy from a 2026 shock event? Because black swans don't send warnings, and the difference between an investor and a professional allocator is risk management. Risk management framework, the layered defense strategy. Let's reset something right now. High yield does not mean low risk. Dividends do not mean safety. And diversification does not mean immunity. 2026 is stable, but fragile. Rates are holding around 4.5%. Inflation has cooled, but not disappeared. Infrastructure spending is accelerating. But global debt levels remain elevated. This is not a crisis environment. It's a late-cycle environment. And late-cycle markets require discipline. The margin of safety concept. The phrase margin of safety comes from value investing. It means buying assets below intrinsic value to reduce downside risk. But in 2026, margin of safety is not just about price. It's about structure. Layer 1, stable cash flow, energy infrastructure. Layer 2, cyclical upside, copper/infrastructure. Layer 3, liquidity reserve, short-term treasuries. Layer 4, dividend growth core, high-quality ETFs. This layered architecture reduces correlation risk. When one pillar weakens, another stabilizes. That's how professional portfolios are constructed. Not with hype, with balance. 2026 black swan scenarios. Let's walk through what could go wrong, because smart investors stress test their strategy before the market does it for them. 1. Surprise Fed reacceleration. If inflation spikes and the Fed pushes rates above 5.5%, dividend stocks could compress. Higher yields compete with equities. Long-duration assets suffer. Short-term treasuries? They adjust upward. This is why duration control matters. 2. Global energy disruption. A geopolitical conflict disrupts oil supply. Energy infrastructure initially spikes. Then volatility increases. Copper miners fluctuate with global demand fears. Your treasury allocation stabilizes volatility. 3. Credit market freeze. Commercial real estate default spread. Banks tighten lending. Equities sell off broadly. High-yield ETFs decline short-term. But dividend growth companies with strong balance sheets outperform speculative growth. And dry powder becomes opportunity. 4. Recession shock. Infrastructure spending slows. Commodity prices decline. Dividend payouts may be reduced in cyclical sectors, but diversified allocation reduces single-point failure. The point is not to predict the black swan. The point is to survive it. Because wealth isn't destroyed by volatility. It's destroyed by concentration. The 2026 outlook, capital rotation, is real. Look at the trend. 2021 to 2022, growth dominance. 2023 to 2024, defensive rebound. 2025 to 2026, cash flow rotation. Capital is moving into energy, infrastructure, value equities, yield-producing assets. Why? Because higher capital costs punish unprofitable companies. Free cash flow is king again, and dividends signal profitability. This is not a short-term trade. It's a structural shift toward real-world assets. The 3 key takeaways. Let's simplify everything. Because complexity does not create wealth. Clarity does. 1. Cash flow is the new growth. Speculative upside is unpredictable. Dividends are measurable. Energy infrastructure and dividend growth ETFs create compounding machines. Financial freedom is built on predictable income streams. 2. Liquidity is power. Short-term treasuries are not boring. They are strategic. They lower portfolio volatility and provide capital for opportunities during corrections. Optionality is an advantage. 3. Diversification is architecture. Copper gives cyclical upside. Energy provides stable yield. Dividend ETFs offer quality growth. Treasuries reduce risk. Together, they create balance. Not hype, not gambling. A system. Exact action plan. Here's what you do next. Step 1. Audit your current portfolio. Are you overweight speculative growth? Do you have less than 5% in cash equivalents? Are you relying solely on capital appreciation? Step 2. Reallocate strategically. Consider building a 4-pillar structure. 25 to 35% dividend growth ETFs. 20 to 30% energy infrastructure. 15 to 25% short-term treasuries. 15 to 20% infrastructure/copper exposure. Adjust based on risk tolerance. Step 3. Reinvest dividends automatically. Compounding is not optional. It is the engine. Step 4. Review quarterly, not daily. Financial freedom is a long game. If you're serious about building passive income in 2026, click the link in the description and download my 2026 portfolio tracker. It breaks down allocation percentages, dividend reinvestment modeling, and income projection over 10 years. Stop guessing. Start structuring. And if this breakdown gave you clarity, hit subscribe. Because we don't chase headlines here, we build systems. Comment driving question. Now I want to hear from you. If markets dropped 20% tomorrow, would you panic or would you deploy capital? Drop your answer in the comments. Because the difference between financial stress and financial freedom is preparation.